question is not only what Janet Yellen's saying about bank deposits and insuring them, because she changes every day. The question is, what should be? What should she be saying? That's what I want to know. Joining us now, somebody who can tell us, Burt Malkiel, former Princeton University economics professor and author of A Random Walk Down Wall Street, which is celebrating its 50th anniversary. Professor Malkiel, welcome back, Burt. I mean, we've been speculating. No one in the world, the Wall Street Journal editorial page, we've covered it. No one knows what Yellen is trying to tell us. The question I have for you is what should be done in what may be the potential for a banking crisis?
Clearly, what the policy should be is that we do not want blanket guarantees of deposits. This would be moral hazard in spades. It should not be our policy, and I think will not be our policy. You want private depositors to keep some rein on the banks. Indeed, if Silicon Valley Bank had in fact been a little more aware of what some of their depositors were doing and what they were thinking, if they had been somewhat more aware of what the private sector rating agencies were saying about them, maybe they would have acted in a different way, and there wouldn't have been this terrible failure. So what should be the policy is very, very clearly that you do not want blanket guarantees. Now, having said that, Larry, and you have been in the White House, as you know, when you had the situation where not only did Silicon Valley Bank go, but all of the regional bank stocks were falling sharply. It looked like people were taking deposits out. It looked like there could be a massive failure of the whole regional banking system and the importance of it, that it is to the U.S. economy. I don't know whether, I certainly would not fault the administration for saying, in that circumstance, we will, if you want to call it a bailout, call it anything you want. But clearly, when you were in the middle of that crisis, to say that we're going to put a temporary guarantee on, I think that I could not fault anybody for wanting to do that under the circumstances, even though I know perfectly well that's not the right policy and shouldn't be the right policy in the future.
Right. See, that's the problem. Policymakers who are speaking to the general public, not just to the, wealthiest people at this crazy rogue bank in Silicon Valley, which is all it was, a crazy rogue bank, but they're speaking to, working folks. Typical American working class type families. I mean, look, Burt, just as a thought, okay, you've got a new lending facility. For heaven's sakes, the Fed would take paper at par. The paper ain't worth par. Government bonds are trading at 60, 70 cents on the dollar. The Fed will take the paper at par. They'll take the mortgage-backed security at par. And you've got the federal discount window. I mean, they put in over $300 billion now of, they've stopped QT at least temporarily. I'm just saying, of all the things, don't mess with the deposit insurance. I mean, after all, Dodd-Frank tried to limit it. Remember, it was $100,000. They put a ceiling on it at $250,000. I mean, I wouldn't go there. I think it sends the wrong message. It says, do bad things and we'll cover you. That's what troubles me.
And what the real failure was, you've had a massive failure of regulation.
Right.
I mean, the regulators actually were aware of what was happening. And what it tells me is you don't want to rely on regulators to make sure that these things aren't going to happen again. And I think that's what really worries me about this. There are two things that worry me. One, that I think the fallout from this is going to be so much more caution on lending, is going to be, in some sense, almost like a point or two increase in interest rates, and I think is much more likely now to push us into recession.
Right.
This is just going to be a terrible fallout from all of this, and it really could have been avoided. And as I say, it was the private sector that finally realized, and frankly, had Silicon Valley Bank had a great deal more capital, I think there would have been a much more incentive for them not to have acted in the way that, I'll use your terms, like a rogue bank.
Yeah, like a rogue bank. I just don't want moral hazard and unlimited government.
I don't either.
You know, unlimited government is a bad
I don't
thing.
either, and I want the private sector incentives to help us not have this problem in the future.
All right. Thank you, sir. Appreciate it.
It
Professor.
won't happen with regulation. It's got to happen with private sector incentives.
I'm with you. That's great stuff. Anyway, Professor Burt Malkiel, thanks very, very much. We appreciate it.